I started out by saying that in 2009 we got our first rally, followed by the summer 2010 or spring 2010 crash. That was the flash crash. Another rally followed by the summer 2011 crash. They were deemed crashes because of the mindset that lingered on following the financial crisis. Everybody was deeming those little moves, now they're small moves in the context of this move. Those were crashes supposedly. Anyways, that's fine. But what I was saying is that originally the consensus was that this was a corrective counter-trend rally in what is to in what was understood back then to be an ongoing bear market. In other words, they were expecting lower lows. Well, that wasn't to be. And when blue wave won, and by the way, I'm using the harmonic Elliott wave model instead of the traditional classic Elliott wave model. In the classic Elliott wave model, waves 1, 3, and 5 internally subdivide into 5 waves. So that would be 1, 2, 3, 4, and 5. And then you would label this wave 1. So, but with the harmonic Elliott wave model, you don't have an internal 5-wave structure. You have zigzags. Zigzags. And the same thing with wave 5, we're going to get a zigzag of some sort. So this B wave right here, see how we have in wave 1, 3, wave 1 and 3, both of them, waves 1 and 3 subdivide into A, B, and C. So same thing here, we're going to get an A, B, and a C. So I'm patiently waiting for the start of the B wave within blue wave 5. Anyways, going back, we started out with a bottom in 2009, first rally, when the pundits were proven wrong and you got that new high in red wave 1 that exceeded blue wave 1. Then I immediately moved to labeling it wave 1 instead of just a corrective ABC. And when that happened and then we exceeded the high of wave 1, we continued on all the way up to the prior highs from 15 years ago. And then what was left behind is a giant cup in search of a handle. And that handle came in the form of the 2015-2016 correction. Once that handle was then exceeded in 2017, then we knew that new highs are awaiting us. And so if the 2012-2015 rally was wave A of 3, the ensuing rally, the one that confirmed upon breaking this dashed green line, was to be the other half of wave 3. And sure enough, we got a rally just as powerful as the 2015-2016 rally. I'm sorry, 2012-2015. At some point, we reached an important Fibonacci milestone. Blue wave 3 almost achieved a size equal to 361.8% the size of wave 1. And from there, the 2018 correction began. We had the late 2018 correction. And now wave 5, blue wave 5 is underway. Now, as I said, this is an ongoing rally that started in 2009. Some people using the classic Elliott wave model may look at it differently. They may say this is 1, 2, 3, 4, and 5. Okay, that's fine. But then you also have another piece of unfinished business. You have 1, 2, 3, 4, and 5. So either way you look at it, there's still unfinished business to be completed before this bull run comes to an end. Anyways, I'm going to stick with the harmonic Elliott wave, which I have been using successfully. And I'm expecting wave 5 to subdivide into a zigzag, similar to what wave 1 and 3 did. So once wave A of 5 comes to an end, we should get some sort of wave B followed by wave C to complete wave 5. Now, the measured move of the cup, the depth or the height of the cup is the projected move. And the height of the cup projected from the rim of the cup gives us a target of 93.55. Interestingly, the financial crisis, the 2008 crash, did not exceed the lows of 2002. In fact, it was 88.6% of wave 1. So as far as the NASDAQ is concerned, the bull market began in 2002. So this is a much bigger bull market that has yet to finish years down the road. Okay, years down the road. But what's going to happen, and I strongly believe, that's my conviction, is that once we reach this area, that's where yellow wave 3 reaches a size of 461.8%, the size of wave 1, to complete the objective of this massive cup and handle. Then we're going to get yellow wave 4, or depending, I'll know down the road whether this whole thing, this rally from 2009 till next year, hopefully, will be all of wave 3 or only half of wave 3. If it's half of wave 3, you can only imagine what the next 10 years will bring you. Something just as big as this. Okay? However, if it's all of wave 3, and regardless of whether it's all of wave 3 or only A of 3, regardless, from here you're going to get a decline that could be at least as sizable, or the target of which would be to retest the lows of 2018. Only then will you get the start of a new bull market. Now, if this ends up being wave 5, 1, 2, 3, 4, 5, then from 5 we're coming back down here. So there's a lot of interesting stuff in the works for years, in store for years to come. For now, though, the visibility is this. We're going to get here sometime soon in the coming months, by end of 2020 maybe. And then we're going to crash. And that's going to be a sizable move to the downside, 40% or so. Okay. So when will wave A of 5 end? And that's what we're waiting on. We don't know yet, but I'm trying to get a few names out of the way as far as earnings before I start looking for the top of wave A. But it's dangerously close as far as the S&P is concerned. It's dangerously close to the prior highs. the NASDAQ 100 has already exceeded the 2018 highs. Anyways, moving on, we have the NASDAQ 100, same exact story. There's no difference. We have a target of about 8,800 for red wave 3 to come to an end, and yellow wave 5, of course. Okay. Now, when you work it out, it's about 17% more upside, at least as far as the NASDAQ composite is concerned. And I'll tell you, it's the same story with the rest of the indices. You look at the S&P, same exact structure. 2009, we got this zigzag that was deemed a counter-trend rally at first. 2011 crash, and then we exceeded that move. We exceeded the top of wave 1 in 2012, and the rest was history. Okay? I was tracking a butterfly harmonic pattern, and when that butterfly harmonic pattern reached the extreme case, okay, the extreme case, in other words, there were 3 PRZs. When blue wave A reached 1.618, the size of the XA leg, when that reached that target, 2138 to 2145, then the correction began. And then when that correction came to an end, we began a new rally that ended in 2015. So same exact structure. The indices don't always have to follow the same structure. They don't have to always move in concert as far as their wave structures are concerned. But that's what we got right now. We got wave 5 underway. How far wave 5 will go, I have no idea. Of course, there's always a textbook target. Fibonacci will tell you the target might be this or that. Gann might tell you the target would be this or that. I'd rather not estimate a target. Instead, I'd let the charts tell me that a topping formation is underway. And when that happens, I'll be able to project a target based on the topping formation, based on various different things. But rather than anticipate, I'd let the charts tell me over the course of weeks and months that a topping formation is underway. Anyways, there is this yellow rising wedge, a broadening wedge. It's got this contact point, it's got this contact point, and it's got this contact point. And so it only behooves us to assume we're heading all the way back up to the top of that wedge. Where it contacts the wedge, you know, at what time it contacts the wedge also determines the level at which it contacts it. If it hits it right here, it'll be almost 3,200. Right here, it'll be 3,300. Further out might be a little more than that. I have no idea. And no one can tell you that with a straight face unless they're professional liars. So you'll have to wait for conditions to change before you can make some assumptions. Right now, we cannot make any assumptions as far as the extent of wave 5. Moving on to another index, the transports. Now, here's something very interesting. We learned, or at least I did, from the 2013 breakout, because I was there when I noticed it right here. I saw this consolidation throughout 2012, then a breakout in 2013. Then I looked at the transportation stocks. I looked at a whole bunch of them, 20 or 30, and every single one of them had a bullish pattern from where it was, that stock was breaking out. It was confirming the bullish pattern with a breakout. And look what happened. Boom. 2-year rally, 13, 14, 3-year rally actually. Same thing here, 2016, we had a base that formed, and then we broke out in 2017. What do we have? Same exact thing. What do you have now? Same exact thing, a formation similar to the prior ones, and that tells you to expect another rally, maybe not as intense as what we saw here, because that's part of wave 3, A of 3, B of 3, and C of 3. Now you're going to have wave 5 underway, and then wave 5 usually is less intense than wave 3. So this may not last as long as 3 years. It could be 1.5 years, 2 years max. Moving on to the SOX. The SOX is way above, substantially, I would say, significantly, noticeably, whatever, above the 2018 highs. This alone tells you that the correction indeed ended in 2018, and now we're headed up to the wave, the Fibonacci textbook target is a range 1868 to 2057. Somewhere around here, we're going to end this bull run. But this is a massive cup. And that massive cup started at about 200, ended near 1400. So that's 1200 as far as the size of the cup. But those targets, these measured moves associated with these patterns, are really guidelines. They're not chiseled in stone. I prefer to rely on my Elliott wave count right here, and I would be looking for wave 5 to end in the 1868, 2057 range. So once the SOX reaches its target, and it's going to continue to outperform the other indices, I'm going to expect it to top. It's going to reach a high ahead of the other indices, just like it did in 2018. It topped in early 2018 and then embarked on a series of lower lows and lower highs, even though the S&P and the NASDAQ were forging ahead towards new all-time highs. That's probably not going to happen, or it's probably going to happen kind of similarly to this. The SOX will top early on, say, I don't know, maybe late 2019, and then maybe the S&P, the NASDAQ, the rest of the popular indices will top in early 2020 or something like that. But what I'm saying is that we need to be looking for, or be on the lookout for, those sort of divergences. Those divergences are going to tell us that there's something not right, and that's exactly what 2018 was all about. And what will probably happen is, with the S&P, is at some point when the SOX reaches that target, the S&P might be somewhere around here. The SOX will turn down, or will reverse course with a vengeance. The S&P will dip, and then the SOX will try to retest its highs end up making a lower high, but the S&P will make a new high. And then you'll have something like that, some sort of a head and shoulders that will consume several months before it finally breaks down and retests the 2018 lows. But as I said, this is a year and a half from now. The interesting thing is that what is going to cause this? What's going to cause this sort of correction? Is it going to be a recession? Will we finally get a yield curve inversion? Because the inversion that happened was really not an inversion. There was no inversion really when you look at the 10-year and the 2-year. It came close, but it wasn't a bona fide inversion. And in fact, when inversion takes place, while yields are falling, it's a false signal. Yields will have to be rising when the inversion actually takes place for it to be a valid signal. We'll talk about that in a minute. That's the SOX. The Russell is in the same boat. In fact, I noticed that it's moving in a parallel channel. When I drew that blue line yesterday, and then I took it and projected it from the bottom of the 2016 correction, I noticed that yellow wave 4 found support right at that line. So what I did is I took this blue line, drew a parallel line starting from this point, and then I saw that it ran through the bottom of wave 4. This tells me that when the Russell tops, when wave 5 is finally in the books, we're going to be somewhere around here, you know, the top of the channel. Now notice how badly the Russell 2000 is lagging the other indices, and this to me is an indication that there's probably concern about the U.S. economy moving forward. Maybe those concerns will abate down the road, or maybe with the boat or with the tide lifting all boats, the Russell will have to comply. Maybe it'll make a new high, but still underperform the NASDAQ, the SOX, so on and so forth. But it warrants keeping an eye on it to see how it performs relative to the rest of the market. Same thing with the transports, by the way. Even though they're finally coming back to life, they're nowhere near their prior highs. Looking at the Dow, near its prior highs, of course. That's why you're seeing a little weakness here and there. Wave 3 almost got to where it equals in size 261.8% the size of wave 1. Wave 3 almost got there. 261.8, came down. I was surprised that it didn't come all the way down here. It's probably because the other indices reached support well ahead of the Dow. But I was pretty confident we're going to get down here before wave 4 is in the books. And that's why I missed this rally since late December. Okay. The next time my approach is going to be different. As we approach a certain target, I'm going to start accumulating instead of trying to time things to perfection, which didn't work this time. The S&P came within 2 or 3% of my ideal target, and so did the Dow. So what is the target for wave 5? No one knows. It's going to be whatever it is. It's going to be dictated by events, okay? The events of the day are going to dictate the end of wave 5, but as the chart pattern continues to evolve, we will know when the end is near. Okay, it's nowhere near right now. So the question is, what's going to happen in 2020? It's an election year. Okay, what is going to happen? Question is, will we, here's a scenario. We're going to end wave A at some point, wave A of 5. And then wave B of 5 is going to begin. Will we get wave C in 2020? Or will 2020 be a sideways, protracted sideways move ahead of wave C? And will this consume much of 2020 ahead of the elections? Okay, so believe it or not, this pattern is going to help me also predict what the outcome of the presidential election is likely to be. But that won't happen till probably summer 2020. All we know is that it behooves you to be long if you're an investor. You're not an options trader trying to make a buck every week, but you just want to put on some positions and wait for this market to run out of steam. You can be long right here as long as you can, or you're willing to weather whatever might come here before continuing on higher. Okay, if you're willing to buy right here near the highs and weather whatever is to come in the form of wave B ahead of wave C, that's fine. You can just buy and go away. But I think wave A, I'm sorry, not wave C, wave A, B, and C. Wave A in all the indices, I think it still has more to go because Apple still has more to go as well. In other words, I'm going to show you the Apple wave structure, and you'll notice that it still has several percentage points of upside before its own wave A comes to an end. And I'm assuming that once Apple's wave A comes to an end, the NASDAQ's wave A will also come to an end. And only then should we begin to look for the start of wave B. All right, so I'm going to keep on going here. I look at the banks, the financials. For me to track the financials, I use the NASDAQ banking index. And the banking index had the same exact pattern. And the fact that it got this low should have been reason enough for me to suspect that wave 4 has ended and we're ready to move higher as far as stocks. And so this guy is lagging right now. The financials are lagging the other indices, but I don't know where they are today, but this chart is from the weekend. I suspect they're right about where they are right now. But what's going to happen, I think, because of the this vicious crab pattern, this crab pattern has a minimum target of 48.67. So I suspect wave 5 will end right here. And this will be another indication that the bull market has run its course. So those are the things I'm looking for. Again, I'm looking for NASDAQ composite to be right near 93.55. I'm looking for the SOX to reach 1867, 68 to 2057. Okay. And then I'm also looking for the banking index, the NASDAQ banking index, to reach the 48.67 area. Get back inside the green box and make an attempt at reaching the top of that box, certainly exceeding yellow wave 3. When you look at Treasury bonds, as I said many times before, the market was pricing in 2 or 3 extra rate hikes that never happened. And the moment the Fed turned dovish, bonds took off with a vengeance, along with stocks. Why? You know, sometimes they tell you bonds and stocks, they move opposite to each other. Not true when it's not true all the time. In fact, when interest rates are dropping, it's good for stocks generally, and it's good for bonds because, you know, that's the relationship between the prices of bonds and their yields. If the price of a bond falls, the yield will have to rise, or vice versa. If interest rates rise, the price of bonds will have to account for that by dropping. So right now we have an ABC on the chart as far as IEF is concerned, A, B, and C. And I think what we have on hand here from what I'm seeing is a 5-wave structure. Bonds right now are off their highs, so maybe they're going to start dropping, retest this area, and that's when wave B in stocks will end. Okay, and IEF is probably leading right here. It's probably leading. So they're not all, in other words, bonds and stocks are not going to start to fall together. For example, if you notice right here, bonds bottomed in October. Stocks bottomed in December. So at some point the string is going to snap as the IEF continues to fall. Then suddenly stocks will wake up and they will fall too. But then when support is finally reached, we're going to get another 5-wave rally in IEF, and this will also mark the start of the next leg up in stocks. So that's the sort of behavior that I'm expecting. Here's the yield curve. If you look at the black line, that's the blue line. The blue line marks depicts the 10-year treasury, and the green line depicts the 2-year treasury. As you can see, rates are falling. Rates are falling across the board, across the entire yield curve, but the 10-year is yielding higher than the 2-year, and as long as that is the case, the differential is positive. 2-year yield, 10-year yield minus 2-year yield is positive. You do not have yield curve inversion. Okay, in fact, we never got to zero. We came close in December, but we never got to zero. So there is no inversion, and as long as there is no inversion, by the way, when we came close in December, rates were falling. You know, they're on a downtrend. So that yield curve inversion, had it happened, it would have been a false signal. Okay? We need inversion to happen in a rising rates environment. Only then will inversion be a legitimate signal. And I can refer you to articles about that. Don't listen to what is being said in the news media when some pundit comes up on TV and says, oh, we're having an inversion, this and that. Not the case yet. If you look at SHYG, high yield corporate bonds, if the prices of corporate bonds are rising, what does that mean? It means that corporations are able to borrow money at lower rates because the price of bonds is inversely proportional to rates. So if they can borrow money at lower rates, that means the stock market overall is still healthy. The uh, risk taking or the appetite for risk is alive and well. There's nothing to worry about right now. Unlike what we saw here, 2017, we had a high. In 2018, we had a lower high, even though stocks made an all-time high. Lower high in bonds tells you what? Rates are rising. Bonds are cheaper, which means that rates are higher. And this in and of itself presented or constituted a bearish divergence. Lower high in bonds, higher high in stocks. So right now we're still in a new fledgling bull run. We're going to get something. We're going to get something like that. Maybe retest those highs, or those highs. I'm not sure exactly where it's going to end. I think we're going to get something like this, a zigzag, where this leg is wave C, this was wave B, and this was wave A. So we're gonna be somewhere around here when the stock market finally reaches its target, or the end of that bull run. It all depends on what they want to do with interest rates. It all trickles down to all this business. Now there's talk again about, the next move will either be neutral or a rate hike. There'll never be a rate cut. So if there's not going to be a rate cut, what does that tell you? It tells you they began to raise rates where? Right about here, right? So they started raising rates here, and now because they pressed the pause button, they turned dovish for a while. You can expect probably a lower high in bonds, treasury and corporate, but the stock market will make an all-time high yet again. So then the stuff will hit the fan if you do get some sort of an event, whether it be a recession, an unexpected outcome in the presidential election. Something is going to happen, that is going to cause the market to reverse course. But again, this is not something you want to act upon right now. This is something that I'm forecasting right now that I'm going to fine tune along the way. Every month, I'm going to see if things are progressing according to that forecast, and should there be a need for an adjustment, some fine tuning, I'll certainly do that in terms of price targets and timing. Okay, so this whole thesis will have to be scrutinized, will have to be verified along the way until we finally get confirmation. But for now, I think the waters are calm. You can dip in, and for the next few months, and I think they'll do everything possible to prop up stocks in 2020. That's my opinion. Look, we had a 90% day volume-wise. In other words, in late December, I think it was December the 26th or the 27th, we had 26, actually, I wrote it down. 26 up volume made up 90% of all of the volume. And then after that, we had occasional 80 and 70% days. I can tell you, whenever you get 70% days, it's a good thing. It's sustainable. But when you get a 90% day, that's unmistakable constitutional buying. And 80 plus too. Okay, so we've had an 80 plus here in late May, and that propelled stocks a little higher. But, you don't get them every day. You get them when they decide to buy. They on any given day, the market reaches support. They say, okay, I'm going to get in right here. They buy their positions, and that's it. They're not day trading, the institutions. They're just, well, unless they have a trading desk. But from an investment standpoint, the smart money, hedge funds, all these money managers, they're buying once and they're sitting on their positions until they have reason to exit them. So this doesn't say anything right now as of what's going to happen next, okay? But the 90% day goes to tell you that, look, we had a 90% day here in April 2018, and that carried us all the way to almost the end of 2018. That 90%, I'm sorry, there was a 90% day. Those were all 80% days. So we haven't had a 90% day, I think, since 2015. I'll have to go back. It doesn't matter. Anyways, this is an unmistakable signal. Usually I would need two of these. This time only one took place, and two within a 3-day period. At least that's the theory. So when I saw the first one, I kind of dismissed it. I said, you know what, I need another one before I can do anything. And that never came, and I missed the opportunity as far as the indices are concerned. Because if you recall, I kept looking for that final leg down to below 2,300 before things could turn back up with a vengeance. But they ended up turning up with a vengeance anyways. Continuing on with this chart right here. This is a little alarming, and this is something that I've developed on my own. I look at the ratio of the S&P equal weighted versus the capitalization weighted. And the ratio of equal weighted to capitalization weighted gives you an idea of the breadth in the market. Is the rally all encompassing? Is it focused only on these high capitalization stocks, or is it across the board? For example, look at what happened in 2013. We had if you look at from 2009 to 2013, it was one heck of a, one heck of a rally across the board. The equal weighted S&P was outperforming, not every day, but in general, trend-wise, was outperforming the capitalization weighted. And then right around 2012, it started, underperforming, not alarmingly so, okay? In other words, in 2012, we had actually, what happened in 2012, or starting in late 2011, summer 2011, that was the crash, by the way, here. That was the crash, 2011. And so right around 2012, we started rallying, of course, but the rally was narrow. It wasn't widespread until 2013. When 2013 came, then it was across the board. The tide lifted all boats. The equal weighted index outperformed the capitalization weighted index all the way till 2015, 2016. Then what happened? In 2017, even though the market was, the stock market indices were plugging along, we had a little bit of a dip into 2017. Wasn't alarming, but breadth was narrowing. And then we had this in 2018. And then throughout 2018, what did we get? This. Breadth was narrowing as the indices were attempting and succeeding at making new highs. Funny thing is that now that the indices are back where they used to be, this sucker is still near the lows. What does that tell you? This is another indication that breadth remains narrow in general, okay? That what's probably lifting the indices back to and beyond their all-time highs is a smaller basket of stocks, a smaller basket of stocks. And this is typical of wave 5, by the way, in the stock market. 1, 2, 3, 4, 5. The most potent rally is wave 3. This is the sweet spot right here. This wave 3 here is when things happen like this, okay? And then what happens then is when wave 5 makes a new all-time high relative to wave 3, you have a higher high in stocks, but then you start getting lower lows in breadth, or lower highs in breadth. That's what I meant. This is the very definition of a divergence, a bearish divergence. Is this something to act upon right now? Absolutely not. That's not something for you to act upon immediately. But this is something to keep track of for months to come. All right. Finally, I'm going to talk about Apple a little bit. Apple has what I believe is a typical 5-wave rally. Very, very similar to what's going on with the indices, even though I cannot discern the subdivisions in the indices with the same clarity that I can do with Apple. But here's the thing, Apple right now, whatever was causing it to underperform is now a tailwind, you know? And so there's nothing stopping it from revisiting the prior highs. And those prior highs don't have to be hit right on the head. But if I look at it, I see that wave 3 reached 2.764, the size of wave 1. Then I got wave 4, and now we have wave 5 targeting this area right here. So I feel that when Apple finally is ready to announce, we're going to get one of two things. And it depends on what's going to happen in the next few days prior to the announcement. This might have been wave B right here. So I don't know if that's the case or not. All I can tell you, though, instead of trying to split the atom here, all I can tell you is that wave 5, whatever happens in here, okay, whatever noise happens here, that wave 5 is probably going to retest the highs, not the 233, 234, but I think Apple will reach as high as 220 to 227, most likely 224, because there is a demarc TDST level at 224. It's a resistance level near 224, so which is right inside this this zone. Okay, and then when this happens, I think it could cause the rest of the market to continue on higher to finish its own wave A. Once Apple is done rallying, the first phase of its new bull run will end alongside the rest of the indices. Only then will I consider taking a short position in the indices. For now, though, I'm not going to do any of that. If you're interested in the longer term path for Apple, here's the monthly. To the best of my abilities, I can see that wave 1 ended, believe it or not, in 2013, right around $100. Then you had that 2013, might have started in 2012 actually. The high was in 2012. And then in mid-2013, we had wave 2. And then we started getting some real acceleration. Wave 3, if this is correct, wave 3 ended at the 1.764 size, a size of 176.4 relative to the size of wave 1. Wave 4 is 50% of wave 3, which means that wave 5 will eventually reach new highs well above the prior highs, maybe 50, 60 or more points to the upside. We'll find out sooner or later. But right now, here's how I feel it's going to happen. You're going to get a rally to about 224, a pullback to 200, maybe 197 even, and then the next leg up to finish wave 5. So you have Apple as an indication, as a stock to keep track of, to time the end of the bull market next year. You have the target I presented or offered on the NASDAQ composite, the banking index, and the SOX. Okay, those are all the ingredients or the factors that you need to keep an eye on, the elements, whatever you want to call them, the data, the charts, the indices, the things that you need to keep track of in order to time the end of this bull market. Anyways, I'm running out of breath and focus, actually. That's why I'm babbling. I apologize. Anyways, are there any questions you want to ask me at this point? Any questions at all? Google is another stock, Apple position. No, I cannot do a quick analysis of Netflix. There's nothing quick that I can do about the stock. Okay, I have to look at it in depth. Apple position is, as of the other day, we are short 207, 210 expiring this week, and also 200, 197. It's an iron condor. Am I correct? So am I going to buy it into earnings? You know what? No, I'm not. I'm going to just be happy with what I've done with it prior to earnings, because I am not positive if the reaction to earnings will be a quick knee-jerk reaction to 197 before it turns around and heads up to 220. Okay, but if I wake up on May 1st, I think they report when? April 30th or something. Okay, if I wake up the next day and I see that exceeded a certain target and it's headed towards another target, that's when I'll buy or I'll sell a put spread or something. But I'm not going to gamble on it right, going into earnings. Okay. At least that's my mindset right now, is that I just want to stand on the sidelines, watch how it reacts, whether it confirms what I was expecting, and if so, that's awesome. Anyways, what else do you guys have as far as questions? Here's an interesting thing. What do I expect prior to earnings? Right now, if you notice where it's trading, as I'm speaking to you, it's exactly at 204.47. Right now, I'm looking at my other screen. It's at 204.47. Guess what 204.47 is? It's the gap that got filled today, 204.47. So is it going to get to 210 immediately from here? I don't know. it might consolidate for the next few days to frustrate everybody, and then it will decide to move after that. Okay? Anyways, any other questions? Is everyone clear as to what my current stance is? Here's what happened with it today. It dipped down to, let me see if this is correct. It fell down to about 202.30, meaning it tested last week's value area high right here. And then it left behind a tail. This is a tail, a buying tail at 203. This tells you that it's likely not to fall below 203 this week, right here. Okay? A refusal to drop below 203. What else do you guys need to know? If you have questions about individual stocks, whatever, if I have time, I'll be more than happy to do it, but just shoot me over an email. I can't just look at a chart and give you enough insight other than tell you, oh, it looks good. I can say that because it looks good or it looks bad. Whether it's going to continue to look good or not needs a little more exploration. So you asked me about JPM. I said the banking index has a lot more to go, and that's going to lift all the, let me look at it, see if I can glean something from those. You know that I haven't looked at individual financial names in years. So this obviously is forming a base, and this base has a lot more to go. Let me see, this is the yearly auction. So this thing has support at 110, but it's probably headed and approaching 116.50. If it gets above 116.50, it's probably headed towards the all-time highs, and after that, you might come back and look at this whole thing as a bull flag. This whole thing is a bull flag ahead of more upside. You know, they reported, a lot of these guys reported, and they seemed to be fine, right? That's what I heard. I didn't look myself. It's just secondhand information from what I heard on CNBC. If I look at it from a monthly standpoint, 10-year, you know, this thing is, okay, I see. Yeah, this thing, this is definitely a flag right here. There's a lot more upside in the coming, and it seems to be sporting the same pattern that we saw before. In other words, it's in its that was wave 4 right here. So 3, 4, and 5 somewhere up here. Okay. So look, if the overall market has 17% more to go, roughly speaking, factor that into the equation. So I can probably do some Fibonacci work to let me see if I can do it here quickly for you. And maybe I'll take a look at Netflix afterwards. Let me get a 20 20 years worth of data. This way I get the full spectrum. So we started the rally here, March 2009. Interesting. And the stock was so cheap back then. I doubt it'll get that high, but you know, Fibonacci wise, it says 155. I don't put much stock in that. I mean, I wish things were that simple. You just come up with a Fibonacci target and say, this is where the stock is going, without doing your due diligence on stocks. All I can tell you is that from a wave perspective, there's more upside. How much upside? You'll only know when you see a topping formation on the chart, or when, you know, fundamentals change. Maybe interest rates begin to rise, signs of a recession, yield curve inversion, difficulty borrowing money, who knows, regulations. It's a lot more complex than just looking at a chart. But the chart will tell us when things begin to sour. So here's the other thing is you asked me about Netflix, and I wasn't willing to look at it because I hate it, be honest with you. I really do hate the stock because every time I tune in, there's nothing to watch that's worth watching. So it's a personal thing. In the immediate term, this thing is headed up to here, 384, 383, 384, okay? In other words, that's what I believe will happen because I've seen a million stocks and they all form the same kind of pattern. You're going to get, it's going to get as high as 383 or 384. And then likely it will, because, you know, the, what do you call them? The earnings are behind us. And then you probably will get something like this. It dipped down to about 325 to 320. And then when it finally breaks, if it dips all the way back down here, it's a place to buy right about here. 300 to 320. And then when you see a bottoming candle, a session, a reversal sign, a sign of a reversal, then you know you're headed back up towards 350, the black line, and then 384. Once it breaks above 384, then it's going to head much higher. But this will also be wave 4 and wave 5, and the next bear market will take it back down to here. Okay? Hopefully. Any other questions? Any other questions? Share the red 50 MA. You mean the script for the red and green 50 MA? Yeah, I can send that to you. It's for Thinkorswim, right? Yeah, just email me. I'll send you the script. All right, any other questions, folks? If that's it, then I'll call this a day and we will probably reconvene at a later time, probably after Apple has announced. Maybe before, even if there's something to say. But for now, has the SPY yet managed to close above 290.10? I want to show you something before I leave. Let me launch my e-signal for a second here. Let me launch my e-signal. I want to show you why it's taken its time. Why the resistance. It's really technical more than anything. I'll show you in a minute. And then I'll let you go. But it's really a demark thing. It's a demark resistance level. It's a sell signal. That's a demark sell signal. My e-signal takes a little bit of time to launch, but it's launching. All right, that's Apple. VIX is falling, so something to keep an eye on. SPX. Daily chart. So we started out with a 913, and that 913 was invalidated when we made intraday highs with a close that exceeded the stop level. Nevertheless, we did get a pullback, and then we began to rally again. We have a 913.9 right here. This is called a 913.9. And this 913.9 has a stop loss. In other words, if they're selling into it, the stop loss on this 913.9 is twice the height of bar number 8 because it's the highest high within the 9-bar series. Now watch this, which tells you a lot of this daily stuff. From day to day, it could be just a technical game, but you'll have to look beyond that. All right, so if you notice the black line, this is the stop loss. In other words, if you take that 913.9 signal and you go short, your stop on a closing basis will have to be 911.12, 29.11.12. Well, we've never closed at or above this 29.11.12 level, and that's where the resistance is coming from. Now, if I'm right, and we had wave 3 here, wave 4 here in March, this is A of 5, B of 5, and C of 5. If I'm right about this, and I don't know if I am because the wave structure is very, very confusing, then this thing is going to retest the highs here in 29.45, and then it's going to come back down to here somewhere where wave B will be confirmed. And then we'll start to rally again, similar to what we did since December. But this wave B, by the way, could be a triangle, could be, a protracted affair. It could linger on for weeks before wave C gets underway. Frankly, I think this market is waiting on a few things. Google, Amazon, Apple to get out of the way, for the China trade deal to be confirmed, and then there'll be a sell the news event. Anyways, is that all? Do you guys have anything else to ask me? Obviously not, so I'll call it a day, and thank you for joining today. I hope this was helpful. And as I said, once I deem it necessary to get back in here and talk some more, I'll certainly do it. I won't do it just to, fill our time with fluff. When there is something substantive to discuss, I'll do it. Other than that, just keep an eye for, my updates, charts, and commentary. All right, guys, I'll talk to you later.